So we're going to spend the next maybe 40 minutes, 45 minutes talking about succession planning and how do you get your business ready. Um, those are two of the same, but two of the different aspects. You first have to understand what who your buyer is going to be, and then you need to understand how to evaluate your business. So let's start because again, I don't want to keep you. I know everybody has busy schedules, and we'll go from there. So why do people buy an existing business? I'd like to just give you some, set up some timelines of why people buy businesses. Really, because there's an existing base and there's an existing revenue. Okay, whether the revenue is good or bad, again, that's another thing. But again, it's revenue that they can physically touch. They look at also brand recognition, and they look at also market presence that you're there. They will review your business as a proven model. Again, let's forget about sales and profitability. That's the first thing they think. The other reason why some people will buy a business over new was lower risk factor, maybe a quicker path to profitability. Maybe you're not running your business well and they can see that. And again, they don't have to go out and get clients because you do have an existing client base. And maybe with it, that skills that you have in your business, they can relate to their business. So what is succession planning? Okay, that is something that you're preparing your business to continue with a new owner if you're not available. It covers succession, understanding where your business is now and how do you take it new ownership, whether it's internal or external. Really, when you look at succession planning, the first thing you need to do is look to see if there's something internally who can take it over, whether it's family, friends within your business or outside your business, or the last thing, staff members. And really, the benefit is really for some of you, not everybody on this call, is legacy protection. And also, it's very important for a lot of business is that they want employee protection. Okay, more than customer security, it's employee protection. So, what is the risk of what we call the 5 Ds? Okay, so what you have to look for is death, disability, divorce, distress, and departure. And each of them impacts your profitability and your operations. And you need to be able to migrate these strategies. So what we talk about the 5 Ps is really because you are going to have something in your life that when you're in business may follow through. Death of a family member, death of yourself, and then what do you do for the business? You get injured. You no longer can do your job. Of course, divorce, distress, meaning, nervous distress, or you just take off and you leave your business there. And some people do. So again, the other thing is you have to evaluate who do you want to take over your business? Who and how do you prep that person? So let's say you have a person, and the easiest person to find for you to sell is someone internally. Okay, so if you have an internal buyer already, then people like myself don't need to get involved. Okay, so you look at leadership. You look at financial acumen. Maybe the person internally doesn't have the money to buy the business. Maybe you're going to do what we call a VTB, a vendor take back. Look at the people who's the strongest in your operation. And what about communicating to the staff members or or your family member saying, when I want to retire, I want one of you to take over the business. And then through that, come up with a strategic plan. So basically, what I'm saying is, why does succession planning matter? One, it protects your business value. So internally, if you can get someone to buy your business, there's more value than an external people. If there's a family legacy, how many times do you have a business that's been around for 30, 40 years and the owner's ready to retire? There's a flower shop who's been around in my area for 42 years. They own the building, so now they're trying to sell the building, but they're retiring. And none of their family members wanted to take over the business, and it looked like a successful business. And they just lost their whole legacy of what they've built up for 42 years. They say, and this is an interesting statistic, 70% of family businesses fail by the second generation, and 90% fail by the third. So if you are taking your family through the process, and you want you want your son or your daughter, and then your son and your daughter want their kids to take out, there's a big failure rate. So you need to prep your family, or whoever is taking the business, if you want that legacy to continue. They say that when you do a financial impact or on a business, and you understand who's going to take over your business, they say that the survival rate is a lot higher, of about 85%. Once you know what your exit strategy is, you have a better chance of surviving the business. You also have a better chance of keeping employees, because those employees are not know, as you get older, or they overhear that you're selling, and there's no successor, they tend to maybe leave. You also get sales value, meaning, and this is interesting, 100% sales value if you have, because what happens is you build the sales to, let's say, $1 million. A new owner comes in, and sometimes, not always, sometimes it actually goes down because the business was all about you. And that becomes the customer retention. If you do have a vision of succession, and let's say you want a family member to take over your business, then you slowly introduce it to the customer, saying, this is my son, my daughter, my nephew, my niece, who's going to be taking over the business. So it's very interesting, those statistics. It just says whatever you do in life is, plan. The saying is, fail to plan, plan to fail. And that's always my saying that I tell my kids and my employees in my business is planning. So what are some challenges of succession planning? Okay. There's some emotional resistance. So a lot of times, the owner gets so involved in the business. I mean, I just heard several times when someone says to me, you know, I want, and this is a location in Ottawa, I want someone to take my business over, and I want them to keep my legacy. And it's an external person. I will not sell to just anybody. Okay, so do you want to sell? You don't want to sell. So, there shouldn't be no emotional in. Some of the other things that you may have is family conflicts. Let's say that you're the father or the mother, and one of your children say sell, not sell. Then also you have to be careful of legal and tax complication. Do you do a share deal, an asset deal? And then the last problem of some problem is succession planning. So there's really no successors. You don't have family members. You don't have anybody on your team, and you have to go out. So basically, what you need to do is identify the successor. And once you identify the successor, you have to assess the business value. Okay. And then you have to set timelines. What is the shortest time you want to be out, and what is the longest time? And a lot of times, step three depends on step two. If you're over evaluating your business or you're undervaluating your business. Step five is consult a professional lawyer, an accountant, or advisor so that they can help you assess the business. And then start your conversation. And again, I think I just skipped the 4 to 5. But anyways, you get my point. Is basically, talk to your family and staff, and then consult with a lawyer. So this is a real scenarios where, business A, it was interesting. I sold a store. I sold actually more than a store, a master franchise. And after they bought the business, they died. It was just a weird scenario. And the father passed away, the son was in the business, and the son really didn't want to take over. He was hoping that, he could go off and do something else, help his father at the beginning. And all of a sudden, they had no successor. The son didn't want to be in the business. They were forced to sell at a huge discount. The employees left, and again, over time, the employees and the customers left. And with a succession planning, I've seen it where, in advance, what happened is someone came to me and says, I want you to help me set up. I want to do a share deal, and I want 4 of my employees to set this up. They had a plan, they sold it, and everything is still going well. So how do you prevent your second generation to failure? Whether it's a family member or something, is again, if it's an internal person, because you do want your employees and your family to succeed, is train rather than assume. Okay? Don't assume your employees or your family know everything about the business. Also separate the family and the business world. So I worked for a company, and I had a huge company, restaurant company, 40 locations, and it was a father business, and a son was supposed to take over. The son did not call the father dad at work. He called him by his name. There was a separation that, a family member needs to assume whatever role they have in the company, and there shouldn't have been, treat them with the same respect and you would treat your other employees. Documentation and open communication is so important these days for understanding. And also, that's very important, is advisors. Okay, get yourself an advisor. That's very important, that you trust. Okay, and get an advisor that can assess your business that's realistically. Okay, business do not sell unless they have a realistic value. So assess and plan, you're going to implement your succession planning a lot faster. You have to have documents and legal guidance with family, reduces disputes by 80%. Financial advice and evaluation increases your exit value. And then ongoing support helps retain your employees and your customers. So this chart is very important. Okay. Assess and plan, you're going to be able to exit 50% faster. If you have a successor, 90% faster. If you have the proper documentation, there's no fights in the family, 80%. If you evaluate the business, you're going to exit the business 40% faster. A very good slide, actually. Now, If you don't prep properly to sell your business, 70% of small businesses fall apart before closing. And that's a very important factor. Do not put your business for sale if you don't have proper preparation. So many people today come to me, I want to sell my business. Okay, where's the lease? Do you have the lease? Oh, I can find it, but I think I have 2 years left on the lease. Do you have any options on the lease? No. Okay. Again, this is if it's a hard business. Okay. Not so you don't have a lease because 2 years is really nothing to sell. Do you have 3 years financials? No. Did you fill out your income tax with the company for the last 3 years so that you have to show it? No. Do you have POS reports? No. All of this affects the preparation and the selling. People this day is very important. Buyers pay for systems, stability, and this is one of the most important aspect, it's clean financials. So if your business is in a cash business, okay, and you can't prove that there's cash coming through the business, then you're not going to get the value. Because buyers will say, okay, how do I prove that there's $10,000 a month in cash? Really isn't any, and again, they could come in and sit in the business for a month. It's not something you want to do. The less that they're able to sit into your business, the less it affects the operation. Okay? Someone should plan in the event, not at the last minute. So you'll see that planning succession, planning to sell your business is what this is all about. So let's say you want to sell your business and you should take the 3-phase approach. Number one, clean up the mess. If your financials and you have no lease and your equipment's a mess and your sales are down, don't sell your business at that point. Build up and boost value. Once you've done that, then you need to market the business in the proper way. Don't say something that is maybe exaggerated or not true because the buyer and the seller may ask you that to prove it, and then you don't be able to prove it. Then they don't believe anything that's in your financial statements. So phase one, again, clean up your 3 years. A lot of time is we ask people to remove their personal expenses, whether they've done a renovation, recast net income to show owner's benefit. So basically, when you evaluate a business, it's cash flow, and then you have to do adjusted cash flow. Review contracts we talked about. Resolve liability. So if you're being sued, any slip and fall, any employee issues went to the human rights, or it was interesting, and this is a generic comment, is a guy came up to me and said, I just been unionized and I want to sell my business. Right there's a red flag, and I'm not getting in whether a union's right or wrong. A lot of times he knew he had, that unless someone understands and wants to deal with that issue, that could be a problem. So make sure, that you understands any liabilities or disputes. And I'm not saying a union is a liability. What I'm saying is it was an issue that came up that he has to be able to explain why this had happened, and ensure all your license are intact. So phase two is the build-up. Okay, operation manuals. Make sure your team is trained properly. Okay, improve your margins. Start working on cost of goods sold, labor. Diversify your customers, and start showing growth trends. So if you're going like this, that's an issue. I had a store that, showed consistent sales, then went up, high big, huge, like hundreds of thousands of dollars. The problem with this store is no one believed the high increase, but we continued to flow at that high increase. But someone had an issue of how it went from 580,000 to almost, $1 million. The other thing in business they always say is don't rely on a big client. Another aspect, it was a packaged goods company on sauces. They wanted to sell, and their sales went from 800,000 down to 400,000. They lost one major client. It evaluates the business wholly different. So make sure if you're in a business, make sure that you don't rely on one big customer or any key staff members. So if I was in the gelato business before, and my gelato person quit. Well, that is a key staff, and make sure that you always have a backup of 2, 3 people or whatever because again, it's hard to sell that business, a gelato business, if you have no gelato maker. Okay. Then what you have to do is create a sales binder, have everything together, organized, and then understand if you're looking for an investor or an operator. Okay, that's who you need to focus on. Those are the two type of business, and understand where your buyers are going to come from, whether that's an industry person inside or somewhere from outside. So how do you evaluate a business? Okay, you want to sell. There's no one internally. Even if there's someone internally, you have to use what we call EBITDA, interest before income, taxes and depreciation, or seller's discretionary earning, or adjusted cash flow. So if the EBITDA says it's 100,000, and it tends to be higher in non-restaurants evaluation, and it's based on a multiple. So if you're doing $100,000 and your multiple is 3, then you charge your business 3. So you evaluate your business at 300,000, so you put it at 350. You have some room for negotiation because at the end of the day. But remember, if you want to evaluate, remember that there's closing costs. Okay, so there'll be closing costs so if you evaluate your business at 350 and they negotiate 300, there's lawyers' costs. There could be some holdbacks there because of any liabilities that's in your business. If you used a broker, so again, evaluate your business correctly. Get your broker to evaluate your business, or an expert evaluation. Don't overprice the business. Very important not to overprice the business. Understand the business valuation. So very important is quality of financials, revenue and profit trends. What is that whole trend? If you're in the restaurant, and again, lots of restaurants are for sale, your value is dying. Or is AI going to take over your business? And I'm just using that because a lot of people say it is taking over. Then understand your valuation. If, let's say, a key employer in your area moved out, then you need to be able to adjust your price for that. And a lot of times the owner dependency. So I had someone doing $1.2 million in sales, but they are working 6 to 7 days a week. So the P&L showed very well, but it really is not because, well, it still was a great business. But at the end of the day is if someone came in, not everybody's going to work that, 6 to 7 days a week. So again, understand your value. These are things I talked about, clean books, revenues, so I won't get into that. Market your business. Try to keep it confidential. Get everybody to sign an NDA. Share only high level first. So many people get into the weeds and they show them everything at once. Show the high level and then be able to have serious people get them to sign an NDA. From there, give them a little bit, but by that time they need to put an offer in. The sooner you get an offer in, the better it is. Okay. Finance how do you get finance on these deals? There's also what we call a small business loan out there where you're only liable for 25% of the loan. It's a government guarantee. Sellers financing is what we call a vendor take back, or those people that are just going to use your personal savings. So why should you use a broker? And this is very important, why you should use a broker. Because they'll screen everybody. I have a listing right now, and I get calls all the days, and you can't show them to everybody. So I kind of screen the listing. I Broker will help with the negotiation of the offer, so it takes that emotion out of the seller. We'll help you get everything ready on what is needed. If we need to speak to one of the lawyers, the broker can, and we can structure the deal and the transition period. So really using a broker is organizing yourself and taking the emotions out of it. A good broker can also increase the sales price. Okay. They will be able to negotiate better terms, and they'll be able to have more professional materials made up, because usually the broker handles that. What happens without a broker? Buyers would just waste your time. That's the number one thing, or you don't get back to leads. Okay. Or you're distracted from running your business. So where do you find, where do you list your business if you don't have a successor? Through networking, industry contacts, okay, through my company called southbrookbusiness.com. There's other ones, online platforms. And again, on pros and cons of each sources. Online, there's a wider selection, but there's less personal touch, and you have a better chance that it gets out with your staff. Professional insights may cost you more, but again, it could be a quicker exit strategy. So again, last thing I wanted to talk about, get your financials in contact, get your tax returns in contacts, make sure you have all your contracts in place, make sure you have a lease. And again, I just doing a deal now where everybody puts everything in a Dropbox or Google Drive, and it makes it so much easier. Common mistakes of not getting a successor or not determining your price is all of the above. Just waiting too long, asking too much, hiding issues, and just not prepped. So I guess some of these charts is the same thing, is just practical questions that you may ask yourself. And final advice for me is start early, run the business like you're going to keep it, hire the professionals, and know your walkaway numbers, and know who you want to sell to, know the audience. So that is my presentation. I just want to see if anybody has any questions. Okay. I have a question. What's the difference between an asset sale and a shared sale? So again, an asset sale, very good question, is where they're just purchasing the assets. There's no, they're not purchasing your numbered company, and they're not purchasing your liability in the business. Okay, and that's what most people buy. Um, and now there is some tax savings for both. You know, they say share deals are better tax savings, but I'm not an accountant. Now, a share deal is basically where you're buying actually the numbered company and everything within that numbered company and all the assets and liabilities in that company. So again, there's some tax savings. So usually it's a little bit of a lower price, and it's because of the tax savings. But again, I'm not an accountant or a lawyer. The next one is question I have is how much should you evaluate a business in a restaurant? So again, I guess you're asking what the multiple is. Again, restaurants multiples are a little bit lower, anywhere from 2 to 3.5%. How much, another question is how much should you pay a broker? Again, you know, a lot of brokers take about 10% of the sale or a fixed number. So if you're selling it for 100,000, they may say 10%, or they may say, well, that's not enough for them, 20%, or $20,000. So they may do that, you know, give you, you know, a minimum number. Usually it's anywhere from 8 to 10%. Is the key. Lots of good questions. How many years? Another one. How many years do a buyer? Sorry about that. How many years does a buyer um, want of back? Back financial. Okay, I know what he's saying. They're saying it's they want 3 years, minimum 3 years that they should be able to come back. Really, no more. They may ask for 5. That's a little excessive, but normally it's 3 years of past financial statements. Okay. One more questions I see. How do I handle cash if I have cash in the business? My advice is if you're taking cash in the business, and I'm not a government or all that kind of stuff, so I don't care all about all that, is stop taking cash out of your business probably a year before you want to sell, so that you can actually see the sales increase in the business. And that's about it. It looks like I have no more questions. So basically, let me just tell you, if you want to talk about any of this presentation, please call us. Our company is called Southbrook Business Development Group. We help buyers buy businesses. We help sellers sell businesses. We help in businesses increase the sales through both marketing and operations. We help with lease negotiations. We help with construction. So we're a one-stop shop for individual businesses that want to stay in the business and build their business or want an exit strategy. And we also do franchising, and we have a lot of clients. So contact us. Thank you very much for everything. And thanks for attending. We'll speak soon. Thank you.